Today, we're going to talk about why real estate values are down and what you can do about it. So I'm having lots of discussions about this right now, mostly with syndicators and limited partners. This is not the end of the world. Professional real estate investors have been through this before. If you're basing your net worth off your equity, then you're freaking out. But if you're basing it off a cash flow, then you should be just fine. Let's start off with a little real estate 101. You've got your income and your expenses, which is, let's say, rents plus your operating expenses at any given property. That's your net operating income, or your NOI. Then you have your debt, which is your mortgage or your mortgage payment, and then you have your cash flow. This is the formula for every deal. But right now, we have two issues that I want to share with you that are driving values down. Issue number one. Expenses are increasing. Now, a lot of different expenses, but certainly property taxes are going up, insurance is going up, utilities are going up, property management is going up, marketing costs are going up. Expenses are definitely going up on a lot of these properties because of inflation. I'm not going to address income in the form of rents in this particular video, but in many markets, rents are still going up slightly, some are flat, and some are actually going backward. Obviously, if expenses are going up, then cash flow is going down. Income minus expenses minus debt equals cash flow. So as expenses go up, cash flow goes down. That's not good if you're a real estate investor. Issue number two, and probably the bigger issue, is the cost of a loan in today's market, as the Federal Reserve has increased the funds rate since March of 2022. So as you can see here, from a simple $1 million loan, the cost at 3% is $30,000 using simple interest. The cost at 6% is $60,000 using simple interest. So as you can see from this model, as the cost of debt goes up, cash flow goes down. So it should be obvious that the two issues facing most properties are expenses are up and debt is up, driving cash flow further down. Now, in some markets, we're also seeing a little bit of rent increase or income increases. The rising cost of debt is moving much faster than the rising cost of rents in any market in the United States. So now let me show you a very typical deal and why this is important. And this is an actual property that I own. So this property we bought for $19 million, and the bank said we're going to give you about $15 million in debt, roughly around 70% loan to value. And of course, the difference is equity, and that is what you go raise from an investor. The property had an NOI, or a net operating income, as you can see right here, income minus expenses, of $700,000. It was a value add, which means that it was a little dated, and there were things we could do in the unit over time, and we thought that we could have about $133 of rent growth per unit per month. The debt payment at acquisition was around $400, and the cash flow was about $300. So this is about a 7.5% cash on cash return. So what does that mean? What that means is, if I take the $300,000 and divide it into the $4 million, that's about a 7.5% cash on cash. That means real money coming out of the property in the form of cash flow right here. We purchased this at about a 3.6% cap rate, or capitalization rate, which we're going to talk about later. But that is simply taking the NOI and dividing it into the value of the property. So now let's take a look at year 4 after we've done the value add for this property. As you guys can see, we did hit the $133 a unit times 250 times 12. That's about $400,000 that we added to the income, which then spilled down to the net operating income. So we increased the income by $400,000, which also increased the net operating income by $400,000. That's, of course, if expenses stayed about the same. You can see we added $400,000 to the $700,000, and we have now an NOI of about $1.1 million. So we take this to the bank, because the banks lend on the net operating income, and we say, what do you think the property is worth today? So after the bank's appraisal, the property came in about $25 million. So this is a true value add. We bought the property for $19. We created $6 million in value by increasing the net operating income. The bank gave us an appraisal of $25 million, and they said, we'll give you $20 million against that new value. This is a traditional cash out refi, and let me show you how it works. This new loan of $20 million first goes and pays off the existing $15 million loan that we used to buy the property. The second amount goes to pay back the equity, the original investors that we had that originally capitalized the deal from the beginning. And as you can see, we have an additional $1 million to distribute. So at this point, this is what we call an infinite return, because now the investors have gotten all their money back through me increasing the value of this property. Now, the debt payment also went up to about $700K, as you would imagine, because we're financing now a higher number. And as you can see here, our cash flow is about 400 grand. So at this point in year 4, we've done our value add, we've gotten a new loan, we've refinanced out, we've paid back the original loan back, and the investors, and they're into this deal for infinite. They're still our partners. They're still getting cash flow of about $400,000 a year, and they have no investment in the deal. So now let's take a look at the exact same deal with the new interest rates. We're still at 1.1 million, so we still were able to accomplish the value add, but our debt payment's going to be a lot higher because debt at 3% versus debt at 6% is significantly more. So now just 1 year later, we take this exact same property to the bank and our debt costs are right around 1.1 to 1.2 million. So the only thing that's happened on this deal is the cost of debt has gone up. The interest rate on this number has gone up, which has, of course, driven the cash flow to basically zero. So this is the issue that most people are having right now. So the rising cost of debt is the biggest reason why values are going down, as I'll show you in a minute. Nobody's going to buy this property because there's no cash flow based on the current debt, even though it's the exact same property that I would have bought in year 1. So I want to summarize with 5 major things that you need to be watching. Number 1, investors invest in cash flow. So using the scenario that I just showed you, the investors put up $4 million for $300,000 in cash flow, which was a 7.5% cash-on-cash return. The second thing is lenders lend against net operating income. They're not as much concerned about you personally because the property is actually the source of the debt payment, not you. They are looking at you to make sure you can manage it, but the property pays back the debt. Even if you have a rising net operating income through some kind of a value add, if debt is rising faster, you won't get quite the value that you originally thought. So rising expenses and rising debt lower the net operating income, or the NOI. Rising expenses and rising debt lower the cash flow. So when you put on the investor glasses, if debt is going up and expenses are going up and cash flow is going down, they're going to offer less. So putting on the lender glasses, as the cost of debt goes up, they're not going to be able to service their debt because the cash flow to be able to service that debt is actually going down at the same time. So the lenders are going to value the property less and give you a lower loan than you originally wanted, and therefore no cash out refi. So values are going down because cash flow is going down and NOI is going down because investors are offering less as they try to solve to their own cash-on-cash needs, and lenders as they try to solve to their own lending needs as they start to lend against the net operating income, knowing that they need cash reserves to be able to service that debt. So the 2 things to watch moving forward in 2023 are where are expenses rising and what is debt going to do, because it will further erode both cash flow and perhaps net operating income moving forward in 2023 and even 2024.